Brett Jennings with Real Estate Experts here with our summer market update and forecast. We're going to explore probably what you've been hearing in the news. And that question we've been getting is this slowdown that we're seeing. Is this just a correction or is this a real estate market crash just around the corner? Well, let's dive right in and take a look at that. In order to understand it, what we need to do is take a step back and look at the big picture of our last 50 years of the Bay Area real estate market. What you're seeing here in the graph is showing price appreciations and declines going back all the way to 1984. And what you'll see is we've had four major corrections in our real estate market over that period of time. The first one, back in 1991, was an 11% correction. Our second correction came 10 years later in 2001, when prices dropped 10% at the dot-com pop. 7 years after that, we had our great crash or the Great Recession of 2008, where home prices dropped 27%. And then in 2018, most recently, we did have a correction where prices came down 8%. So what can we take away from that? Well, we can say that the average correction in our market is around 10%. Now you may be asking, well, what about that crash in 2008? There we saw prices drop 27% over a 4-year period of time. To understand, though, what created the crash, we want to take a look and understand what were the dynamics behind that. Well, real estate is supply and demand driven, and what it takes to crash a market is a ton of homes for sale. Here in Silicon Valley for the last 20 years, we have around 1 to 2 months of inventory, depending on the season of the market. In 2008, we had 14 months of inventory, almost 10 times the usual number of homes for sale. And that came from a huge wave of foreclosures because people basically were allowed to buy houses with no money down, with no jobs and no income. We definitely aren't in that environment anymore. In fact, 75% of homeowners in and around Silicon Valley have at least 50% equity at this moment in time. And what's happening now? Well, if you look at the far right of this graph, you can see the number of homes for sale is up, but by contrast to what we experienced in 2008, we're nowhere near the number of supply, the amount of supply that's required to crash the market. In fact, this is a quote from Mark Fleming, the chief economist at First American, saying, yeah, there's been a pickup in inventory that we've seen recently, but it's not a big increase in new listings, but rather a slowdown in the pace of sales. Interest rates went up, buyers moved to the sidelines, and that's what caused this. So remember, months supply of homes measures the inventory available relative to the pace of sales. Same inventory, less sales means more months supply accumulates on the market. In fact, this graph here shows kind of what's happened to our supply of homes or inventory since April of this year, just before interest rates started to rise. We had less than 1 month of homes for the sale when the market was white hot. And as rates rose, well, buyers moved to the sidelines and we saw more homes accumulate on the market. But the good news is here, we just seem to turn the corner and the number or supply of homes available is starting to wind it down. Now you might be asking, well, okay, but what about a recession? Is that going to make us susceptible to a market crash? Well, here's some interesting, and a recession is definitely a distinct possibility. This is a quote from the Wall Street Journal saying recession fears surge among CEOs. 3/4 of global executives say that we are in a recession or will be in the next 12 months, according to a recent survey. But what does that mean for buyers in the real estate market and interest rates? Well, throughout history, during a recession, interest rates go up at the beginning of a recession. That's usually what drives us into a recession. But in order to come out of a recession, interest rates are lowered to stimulate the economy. Historically, we've seen an uptick in interest rates prior to the recession, followed by a lowering of interest rates. In fact, this is looking at the last 6 recessions we've had, going all the way back to 1980. And if you look at the right side of this chart, you'll see that during every recession, from the inception of the recession to the end, interest rates have gone down. In fact, over the past 5 recessions, mortgage interest rates have fallen an average of 1.8 percentage points from peak to trough. And in many cases, they continue to fall after the fact, as it takes some time to turn things around, even when the recession is technically over. here's what's happening now. Rates are already down 3/4 of a point from the highs that we saw in July. Now, that's going to that is currently causing a little bit of an uptick in buyer activity in the market. But where is the market now? Well, real estate, like I said, is supply and demand driven. So when we look at supply, what's happening with inventory? Well, interestingly enough, inventory peaked on July 22nd, about 1 month ago, and we're starting to see supply starting to wind down. In addition, as I just pointed out, interest rates have also come down. The confluence of these two factors is providing what very well could be a bottom in this correction. Here's again the months of supply. We've seen in July it peaked and it's winding down. So what effect has the raise in interest rates and inventory had on prices? Well, prices peaked in March and prices have come down from their all-time highs by 10%. So when is the best time to buy? There is certainly a window of opportunity. If you recall from the beginning of our discussion, we said that our average correction is 10%. Our market is down 10%. Inventory has just started to wind down, providing an opportunity for some support on prices, and we're starting to see buyer activity tick up. So very well, we could be at the bottom of the market. And what kind of opportunity is available? Well, here's a recent success story. Olympia, one of our partners at Real Estate Experts, helped her buyers save $250,000 off the purchase price and got them a loan at 3.8%. On the property they were looking at was originally listed at $1.6 million. The sellers reduced the price once, they reduced the price down to 1.4, and we were able to go in and negotiate an accepted offer at 1.35 million, $250,000 off of the original price. In addition, Olympia was able to negotiate her buyers a credit from the seller to purchase the loan interest rate down to 3.8%. So our buyers in this scenario got a property at 10% off of peak prices and a loan interest rate, something like you would see at the beginning of the year. So this is what's possible right now in the market. So if you are considering and you've been wondering, hey, we're going to wait for the bottom, we can tell you from looking at this data that that window of opportunity is now. So if you're considering buying, be sure to reach out to the real estate expert that shared this video with you. And until we talk again, this is Brett Jennings saying we'll be right here ready to help you create a better life through real estate.